Good morning, dear all. I am happy to welcome everybody to our 6th annual East African Conference, which we are holding in an online format for the first time ever, as we now have to live in the new norm and ensure everyone's health and safety. We are excited that despite, or maybe thanks to the virtual format, the event has a strong turnout. We have scheduled close to 100 one-on-one meetings between 20 East African companies representing a wide range of sectors: financial sector, insurance, real estate, oil and gas, pharmaceuticals, telcos, breweries, consumer and retail, and utilities. We also have 90 top international and local investors with total AUMs of over 3.6 trillion US dollars. In addition to the one-on-one meetings, we will host 2 public panel sessions with great speakers, one on macro and the other for businesses. I would like to thank everyone for attending our conference. Renaissance Capital has been committed to Africa for almost 15 years. Back in 2006, Kenya and Nigeria became the company's stepping stone to growing its operations across the continent. And we continue to be an important part of the global business. Although we do miss the face-to-face interaction, I know most of the international investors do miss Nairobi. We definitely appreciate the opportunity to reconnect with our clients and investors, the media, and other stakeholders on the most recent developments and outlook for Kenya and East Africa. Speaking of the outlook, and based on our SSA recent report, we expect a V-shaped recovery in Kenya from third quarter of this year. Kenya is likely to lead the recovery in the SSA region. We will discuss the recovery drivers today in our macro panel session. Tomorrow, we will proceed with corporates representing diverse sectors. We will talk over the post-19 COVID world and how to emerge from the crisis in better shape. Before we start the first panel session, I would like to give the floor to my colleagues for a brief macro presentation. Yvonne Mhango, SSA economist with more than 10 years experience working as an SSA specialist. We are proud that this year she has once again been ranked #1 in her category by the Financial Mail Survey. Charles Robertson, we all know Charlie, Global Chief Economist, Head of Macro Strategy. Charlie is a renowned emerging and frontier market specialist, a clear opinion leader who covers a wide scope of themes, including demographics, education, electricity, ESG, fertility, pension funds, saving, as well as ways to examine exchange rates in emerging and frontier markets. Yvonne, Charlie, over to you. Asante and karibu. Thank you and welcome.
Thanks very much, Stanley. You missed out virus expert, which is all I've been doing for about 6 months. Has been absolutely obsessing about this. So I'm going to give you just a few slides on the big picture story. Hopefully, let's go through this sharing business. So what I'm leading off with is, you just watched the latest on the virus numbers in East Africa. We've got a few countries shown here. Kenya's on our top left-hand side. I've put in Uganda, Rwanda. I've left off Tanzania because, as you know, they've not been releasing any data since May. What's been interesting about East Africa is it hasn't been hit badly by the virus, based on the data that we can see. There's been a recent pickup in Ethiopia, but none of the numbers are that significant. If you look at cases per 100,000 people, total as of yesterday morning, in the States, it was nearly 2,000 people in every 100,000 have been confirmed with the virus. And in Kenya, it's just 71. I think the whole debate on the virus has moved quite a long way in the last few months. Most significant is that I don't think lockdown, serious national lockdown, such as we saw in Europe in March, April, or China in January, February, I don't think that's going to happen in any low-income country, apart from possibly a place like Vietnam, which had been quite successful, but it's got a few problems recently. And there's two reasons for that. The reason we're not going to see big national lockdowns is, firstly, they often don't work. And I think South Africa, India, and Peru are the best examples of that. They've seen massive GDP declines after very significant lockdowns, but they didn't stop the virus spread. The second reason is that thanks to the youth, particularly the youth of Africa, the youthful population, the damage, the danger to the population is much, much less significant. And that is true of India, but even more so of Africa, much less significant. So when we looked at the number of the population that was vulnerable to the virus, by weighting the various age groups, we worked out that the vulnerable population was rounded down about 0% in Kenya and much of Africa. And we're seeing that in the data. So far, the deaths, this was a couple of days ago in Kenya, 599 deaths from COVID. That's 0% of a normal death toll in a year. This is a very crude, nasty economist way of talking about it, but it's just trying to point out that it's not having the same health hit. So I don't think we've got significant lockdown issues to worry about in the future. There is second wave concerns for Europe. Potential lockdown, I'm skeptical they'll do it, but I don't think we're going to get it in particularly in the countries we're focusing on in this conference. So we don't have to worry about domestic demand so much being hit. It's more the second round effects from the global economy. Perhaps the biggest, most important long-term second round effect is going to be the much lower debt yields that I think we're going to have in the West. And this has been a trend that's been ongoing for a decade already in the States and Germany, is falling bond yields on the right-hand side. I think tracking Japan, which began this process in 1990, when on the left-hand side, different scale, bit of chart crime, I'm sorry about that. On the left-hand side, you see Japanese bond yields going from 8% down to about, 1% through the 1990s. And we're seeing Germany and the US echoing that. Germany very much so, and America with a lag. I don't think we're going to see US Treasury yields above 2% in the coming decade. And it wouldn't surprise me if we're at 0 by 2030. And there is going to be a desperate bid for yield from global investors. Right now, they're putting the money into US equities and the NASDAQ until a few days ago. But I think they'll end up putting it into EM bonds. They've already been doing that. If you go back 20 years, emerging market bond yields were about 12%, according to this bond index. 10 years ago, they were 6%. Today, they're 4%. And it won't surprise me if emerging markets, and I mean kind of mainstream emerging markets at this point, see yields dropping down below 3%, perhaps even 2.5% by 2030. And that would justify big increases in debt without any increase in the debt burden. So the interest burden might be 5% of GDP. When you've got 40% of debt in 2000, it's still 5% of GDP with 120% of GDP in 2020. Now, those GDP estimates are just guides as to point out how much more affordable debt is. And I think Africa will be a big beneficiary of this, partly because the yields are still higher, because most African credits are still single B and a few double B credits. We've seen, excluding South Africa and Egypt, a 10-fold increase in issuance of Eurobonds by Sub-Saharan issuers or by African issuers in the last decade. And I think it's going to get vastly bigger than that. And this is good news, because all that work on demographics and fertility that we did last year was trying to highlight that until you get your fertility rate down to about 2 to 3 kids per woman, the banking sector remains fairly small. and interest rates remain fairly high. And so the ability to domestically finance your own investment, it's still quite expensive. Now that's going to change. And most obviously it's going to change in Egypt, Kenya, Ethiopia, and Ghana. All those countries are going to see the number of kids per woman drop from 3 to 4 at the moment down to 2 to 3, which is where the green countries are now. And therefore, I think, see an increase in savings and falling interest rates. So cheaper to finance domestically. That's going to happen in the 2030s. But what can happen in the 2020s is using that external cash available from the West to borrow more cheaply and kickstart some of that investment in infrastructure that economies need. What else do I think is a really big deal right now? I think the US election matters a great deal. And this is because Trump has been pushing a protectionist theme, a theme which we're seeing via trade wars that's hurt emerging markets and has contributed to dollar strength. I think he's going to lose because all US presidents lose when they have a recession in the first term, even if it's not their fault, as I'm sure President Carter would have said in 1980 in the wake of the Iranian revolution and the oil price spike. So Trump's likely to lose, and I think that means the dollar is likely to weaken. It's already happened quicker than I expected. I thought this was a post-November story. To some extent, we're already seeing that now because US Fed funds are so cheap, because of these trends that are already underway. And I think a belief then that the dollar's not necessarily the place to put your cash anyway. But I think it's going to get intensified by Biden's victory in November. As I've pointed out before, adult education is a much improved story across Africa over the last decade or two. Most countries are now have the adult literacy needed to industrialize. Kenya's over 80%, which is why it's dark green there. It's the best in the region, according to the latest figures from the World Bank. So the education's there. The one problem we still see, or I still see from looking at the work we've done, is electricity. And you've got that chicken and egg situation. You've got to have too much electricity so that anyone putting a factory into Kenya or East Africa knows there's supply there. But the factories don't come to use the electricity until the supply is already in place. So you get this slightly awkward chicken and egg situation. Cheaper financing, where building up that electricity capacity isn't too burdensome, really helps. And this is why the 2020s and this big savings glut from the West, the older and older West, people looking for yield, it could be such a big deal. I'm going to stop there and hand over to Yvonne for a bit more information actually on East Africa rather than big picture. But I think this is it's going to be a really interesting decade for Frontier, and it's a huge opportunity to kickstart and achieve that faster growth, take advantage of the demographic dividend that's coming. And I will stop there. Yvonne, over to you. You need to unmute.
All right, thanks, Charlie. I hope you can all see my presentation. I'll be speaking through a few slides on East Africa. We expect the East African region, let me make that into a PowerPoint presentation. There. We expect the East African region to lead the recovery in Sub-Saharan Africa. And we expect the economies of East Africa to emerge, or to be among the first to emerge from this particular crisis in Sub-Saharan Africa. Early in the year, we scored the frontier markets in Sub-Sahara using 7 resilience measures that are across the top of the table you see on your screen. And then we ranked them based on their resilience score. So the countries at the top of the table you see there are the ones that scored strong in terms of their resilience, which for us implied that they'll be among the first to emerge from the crisis. And you can see among the top 5 countries that we've got 3 East African countries, Ethiopia, Tanzania, and Rwanda, and Kenya falls in the second quarter of the table. And so, as you can see from this, East Africa generally scores pretty high in terms of resilience. And part of the reason for that is the sizable agriculture sectors in this part of the world, which for us implies that households, at least those involved in agriculture, are insulated from the worst of the crisis. And indeed, if you look at Kenya's GDP growth number for the first quarter, the growth number came out around 4.9%, which was a moderate slowdown from 5.5% a year earlier. And a big reason for that good performance was agriculture. And this was despite the decline that we saw in the hotels and restaurants sector. So we're expecting Kenya to have a good year on the agriculture front. This is on the back of good rains. And we expect that to counter the negative impact on the hospitality industry. Our growth forecast for Kenya for this year is 1.5%. If we look at what's happening in the hospitality industry, and tourist arrivals in particular, you can see there's been a collapse, particularly in the second quarter of the year, and that of course reflects the travel restrictions. According to the Statistics Office, tourist arrivals dropped by 99% to under 2,000 arrivals in the second quarter of the year. And that's from over 300,000 just a year earlier. So that gives you an indication of how severely the sector has been hit by the crisis. And that is expected to reflect in the GDP number that's due to come out end of this quarter for the second quarter for Kenya. However, if you look at the current account, on the trade balance side, it does look as though the impact there, at least in the year to April, hasn't been as significant on the trade balance. And that's because any fall we did see in exports was mitigated by a decline in imports. And that's likely due to the lower oil price. However, if you do look at net services receipts, that did drop by a third in the year to April, and that reflects your hit to travel and tourism receipts. If we look at the foreign reserves position, however, that's remained pretty steady, and that, of course, was helped by the inflows of loans of around $1.7 billion earlier this year from the IMF and World Bank, and that's helped shore up reserves, and they're sitting at around 5.4 months of import cover, which we think is pretty decent and supportive of the shilling. If we move on to inflation, Kenya is probably a minority amongst the key economies in Sub-Saharan that has seen a slowdown in inflation. It's been pretty benign, sitting at around 4.4% in August. And that's supported this monetary easing that we've seen. The central bank has cut the policy rate by 125 basis points, sitting at around 7%. And we do think the benign inflation outlook going forward does suggest that the central bank can maintain an accommodative policy stance, which would be supportive of growth. And move on to the fiscus. As you can imagine, that's been hit hard, mainly by the slowdown in growth, which of course has implied that revenues have fallen. If we look at the deficit for the year that ended in June of this year, that widened to 8.3% of GDP, which is 2 percentage points bigger than initially targeted. And that was largely due to revenue shortfall. This year, the government is projecting a deficit of 7.5%. That's for the year that ends next June. We think there's a risk of that being breached due to revenue shortfall. If we move on just to the rest of East Africa, I look at currencies here. We like East African currencies because a couple of them do trade close to their fair value. That implies low volatility. And if you look at the currencies in that oval that's drawn on that chart, you have the Rwandan franc, Tanzanian shilling, and Ugandan shilling, which are trading close to their fair value and hence relatively steady. The Kenyan shilling is a little more misaligned from its fair value compared to its neighbors. However, as I've mentioned earlier, the external position remains relatively solid. The current account hasn't deteriorated as significantly as many feared, and the reserves position remains as comfortable enough to support a stable shilling. If we move on to the next slide, we've got growth forecasts here. These are IMF and World Bank growth forecasts for the Sub-Saharan African countries. And amongst the countries that are projected to grow, you can see that there's a good showing of East African economies. Uganda is projected to grow at around 1.8 to 3.3% this year. If you look at Tanzania, that's between 1.9 and 2.5%. Rwanda at around 2%. Kenya is projected to grow by 1.5% by the World Bank, but the IMF is projecting a small decline of around 0.3%. Inflation, the commonality in East Africa is that it has remained in single digits. Tanzania, similarly to Kenya, has seen its inflation numbers soften. However, we have seen a moderate pickup in Uganda and a stronger pickup in the case of Rwanda. And the rest of East Africa, similarly to Kenya and most countries globally, did ease monetary policy stance to support growth. Low inflation made that possible, but as you can see in Rwanda's case, that has implied negative real rates, at least when it comes to the policy rate. And that's it. That concludes my presentation. We will now move on to the panel discussion. Thank you. Okay, hello again, everybody. I'll be moderating today's macro panel session titled East Africa, Leading Sub-Saharan Africa's Recovery. We have three distinguished persons on our macro panel this morning. We are delighted to have the Deputy Governor of the Central Bank of Kenya, Sheila 𝗪𝗪𝗻. We also have the IMF representative for Kenya, 𝗘𝗀𝘀𝘁 and our Global Chief Economist at Renaissance Capital, Charles Robertson. The panel discussion will focus on East Africa's recovery from the COVID pandemic and its associated restrictions. The panel participants will look into the factors that are playing in Kenya's favor for a swifter recovery compared to the rest of Sub-Saharan Africa. They'll also discuss how the country can exploit those conditions to its benefit. Two of the panelists will kick off the panel session with short presentations, followed by a Q&A session. I would now like to invite Deputy Governor 𝗪𝗪𝗻 to start off the panel session with her presentation. Deputy Governor, the floor is yours.
Thank you. Thank you very much, and welcome everyone to this session, and thank you for Renaissance Capital. It's very important that the African story be told, and obviously these forums are the opportunity for us to tell these stories. And obviously I can't, in this time of COVID, not also wish everyone health and safety. We would wish that the world will quickly recover from this menace that has hurt all of us. What I want to do today is really to talk about the economic status of Kenya, and I can have my slides put up now, please. And really look at what the situation is in Kenya following COVID, the state of the economy, and what our post-COVID strategies would be. So going to my introduction, slide 3, please. A lot has changed since the advent of COVID across the globe and in Kenya. When we look at the global numbers of growth that were projected, we had about 4.9% 2019, and now we're looking at about 2.9%. So we can see in a matter of weeks, all the forecasts, all the outlooks changed dramatically. And this was a health uncertainty, which is something new to the world. We're used to other financial crises, but it's very unusual. It's been very unusual for the whole world to be hit so dramatically by something that came down to health. Africa has equally been set back by the pandemic, but differently. And I think today that's what we're trying to say. We're trying to understand, because there's sometimes this African view, a story of Africa as if we're all the same, and we're not. So this is now looking at the mixed reactions, the mixed outcomes that have come across the continent. Kenya began 2020 quite strong, and I think this has helped us significantly as the pandemic came in. When I look at our growth, we had growth in 2019 of 5.4. We had projected growth of 2020 in the 6s. Inflation was anchored at 5.8 as in March when COVID hit. The deficit was also declining. At that time, 5.8% GDP for 2019. We had steady remittances flows, about $200 million a month. I mean, I think now they're about $250 million a month. Stable and resilient banking sector, strong foreign exchange with over 5 months of import cover in our foreign reserves, and a stable exchange rate. So really, as COVID came in, I can have the next slide. We had a position that was fairly strong and had some buffers. Now, what happened then? Well, the first case was reported in Kenya on the 13th of March, and the epicenters of the pandemic have been the two largest cities, which are Nairobi and Mombasa. And I think, and I'm not a medical or health expert, But I think from what we've been seeing, it really peaked in these two cities in mid-July. So if you like, we're seeing our numbers come down. I think mid-July we were running at about 700 infections per day. Currently we're running around 100 infections per day. So I believe that that's a sign that we must have peaked and come out. COVID has now moved to our counties, which is our upcountry areas. And this is a concern to us because obviously our cities had better health positions. And also there's a lot of our old age people that live outside of the main cities. However, there is huge advantages that the numbers will be lower. And we've also learned a lot about the epidemic already. So let's just see how it goes. Total cases in Kenya today, 35,000 have been reported, 21,000 recoveries so far, and as Charles said earlier, about 600 fatalities. So as with the rest of Africa, the impact of the pandemic has been muted in Kenya. Positivity rates are coming down, as I said, 80% plus of our cases are asymptomatic, but the uncertainty remains. I'm not a health expert, so I don't want to speak for them. And I would say that the uncertainty remains. The next slide, please. What happened? Well, the pandemic hit us on the 13th of March. So really the first quarter was fairly well secured. And that's why we came out with 4.9% growth in the first quarter of 2020. I think that as we have heard from Yvonne, we've had very good rainfalls and we have a great harvest. And so food prices are muted. There was strong ICT growth throughout that quarter, which also positioned us, if you can imagine, for what was coming with the pandemic and the use of all the technology. And resilience, people forget we're also a regional logistics hub we're the corridor for many African countries from our coastline through. So even when there's a pandemic, there's a need for that logistics to continue. So that has also been rewarding, that it didn't collapse as much as it did in other countries. Obviously, the accommodation, restaurants, and tourism were significantly affected from the date of the announcement of COVID in Kenya, and that resulted in also depressed service sector exports. But remittances have remarkably remained quite steady, and I think year on year we're 6.7% up. I put that down to the fact that the diaspora of Kenya send the money home for vulnerable members of society, of their family, or else as their second homes. And even during a pandemic, it's even more reason to support those ambitions. Next slide. Inflation is well anchored. Inflation is well anchored. Inflation in July is 4.4%, down from 5.2% in August. Down from 5.2% in August, sorry. And I think what we're saying is that that's really due to the good rains, low fuel prices, muted demand. So we're not expecting that to change anytime soon. And our projection is that that would hold for the next 12 months in that region. Current account, this is the number that we're always debating and discussing. It's narrowed to 4.7% of GDP in July, and this is from numbers of about 5.8% in 2019. Recovery of total exports, 1.7% in the 12 months to July. Tea and horticulture have been prime movers on that. What we saw with tea was quite interesting because as soon as COVID became prevalent around the world, there was almost a pre-purchasing of tea. So wherever people could see extra stocks, they were actually buying them. So our tea exports increased, particularly to the Arab countries, to Egypt, and other countries as well. So instead of that declining, it in fact increased. Horticulture as well has done very well. Actually, the tea number is 23%, so it's really quite significant. And horticulture also held its own. I think people were eating healthy, and Kenya's horticulture experts fall within that classification. Diaspora remittances, I've already mentioned them. You can see there that we peaked at $288 million in June. So that's why I was giving you the number of around 250 being the number that could be an average at this point in time. Lower oil prices and a muted economic activity. Next slide, please. Our banks have done really quite well. We're quite proud of our banking sector. They've responded quite well to the crisis. Our ratios for capital and liquidity are above what's required. Credit monitoring, we've gone from 13.3% in July to 13.1% in June. I'll talk a little bit to that during the answers and questions, because there's some other data that I can supply in supporting that comment. But what we're seeing is that among our asset quality in our banking sector, the rate of deterioration, or the rate of decline, has stabilized. And that's because there's many structures in place to both at the planning stage when we first went into COVID, and also now as we monitor what is happening throughout this COVID period. Lending rates have also declined, which was expected. There was an accommodative monetary policy stance that was adopted in March, and there was the decrease in the CRR ratio, which obviously had an impact on liquidity within the market. Banking sector faces really two key risks. One is health, and I'm proud to say that our banks, despite them not being health experts, have responded to the protocols very well. There's not been any instability across our banking sector because of health protocols. And wherever there's been a health issue, everybody has observed those protocols, and the staff of the banks and the customers of the banks, everything has been fairly robust and calm. And that was important for us to make sure was put in place as this problem came in. I think with the banks as well, it's worth mentioning that last year the average profitability of our banking sector was 23%. This year, what we're seeing is around 17%, but it's still profitable. And I think for many countries, they would be very happy to have a 17% profit, despite a pandemic raging across the world. As usual, the banking sector will be guided by international guidelines and standards. Kenya is determined to collaborate with the rest of the world and to make sure that whatever our systems are, that they build the confidence because they're aligned to what is known as global best practices. Next slide, please. When we look at our foreign exchange, what we see is that the reserves are up at around 9 billion, where they've been now for quite a while, 5.4%, 5.4 months of import cover, which is adequate for Kenya. And we have to also thank our institutional partners who responded quite quickly during the COVID crisis and also gave us about $2 billion of crisis support. The look of the Kenya shilling is sitting there in the middle. I think you can see the slides among the African economies as to how it's placed. There's a continual discussion around the pricing or the value of the shilling. We remain absolutely clear that the shilling is free and floating, and that the value, if it's misaligned, is misaligned by a very, very small amount. Going on to the next slide, please. Public debt. This one is more obviously an area that's managed by our national treasury and not our central bank. But it's important to note that we now have around $63 billion of debt, which is about 66% of GDP as at June 2020. Obviously, last year we were below the 60% in the 50% range, and as a result of this pandemic, obviously that has increased. But the composition of our debt, I think people often talk about debt as a singular, and they don't look at the composition of the debt. 47.6% of our debt is domestic, and 52.4% of our debt is foreign. And of that domestic portion, 95+% is locally owned. It's invested by Kenyans in shillings in their government. And so you have to actually split the debt and understand which portion you're looking at. We're all aware that Kenya declined the G20 offer for debt relief because it would have had some impact on its commercial lending terms. So it was preferable for us to not accept that debt relief as a result. The domestic debt target was achieved in 2019-2020, and as at 2021, in the first, 2 months of the year, 2.5 months of the year, we have collected 47%, around 47% of the target. So we're fairly comfortable with the domestic debt achievement to be able to meet the target in the current year. Fiscal consolidation has been the talk of the day, and the current Minister of Finance, the CS of the National Treasury, has spoken strongly to fiscal consolidation and the need for Kenya to achieve fiscal consolidation, even in a COVID era. And I think if you look at the numbers below, you can see the ambition. In 1920, we actually came in lower than was forecasted. So this is evidence of the commitment to reduce the cost and rein in some fiscal consolidation. Move to the next slide. So what's our focus as we go forward? Well, sustainability and stability. I think that is the central bank focus. In the banking sector, we must manage the liquidity and the NPLs, and we must retain the thrust of digital platforms that will bring efficiencies, transparency, accuracy into the future. We must follow global best practice, but use appropriate domestic solutions aligned to global best practice. Our national treasury needs to continue to look at fiscal consolidation. We must support and improve prospects for the youth and the unemployed. That is a problem that's come out of that. And global collaboration in trade and vaccine development. Looking forward, the last slide. The Kenyan economy remains resilient due to its diversification and low dependency on natural resources for exports. The government was alert and responded quickly to the pandemic, which has resulted in lower infection and fertility rates. And based on our assessment, COVID has had a significant impact on the economy, but there are good signs of recovery. These are visible. These are all positive signs, but the uncertainty remains. Thank you very much.
Thank you very much, Deputy Governor. It is encouraging to see indeed that COVID cases have declined from their peak of 700 in July to 100 today. And it's also encouraging to note that remittances have been resilient, and that, you mentioned, tea exports actually improved, which is one of the reasons why the trade deficit hasn't deteriorated as much as many had feared. We'll now move on to the IMF representative. I'd like to invite Tobias Rasmussen to give us a few words and present the IMF's macro views. Tobias?
Thank you, Yvonne, and good morning to everybody. Great pleasure to be with you, and I'm grateful for this opportunity. So in my remarks here, and I won't have a PowerPoint presentation, in my remarks I'll like to discuss developments in the Kenya economy and put them in a broader context of what we're seeing globally and in the region. The IMF came out in June with an update of its regional economic outlook, the RIO, as we call it. So I'll use that as a starting point, and then I'll touch on developments that we've seen subsequently in the global economy and in Kenya. In the RIO for Sub-Saharan Africa from June, we painted a picture of an economic situation that was worse than had been anticipated in April in the World Economic Outlook, and also subject to much uncertainty. In June, economic activity in Sub-Saharan Africa was projected to contract by some 3.2% in 2020. Key elements going into that reduced growth projection relative to April was a weaker external environment, measures to contain the COVID outbreak across countries, and limited policy room for maneuver on the fiscal side, in particular due to falling revenues and limited fiscal space. But also very important to note that there were significant differences across country groups. Oil exporting economies, which had been hurt by the sharply lower oil prices, were projected to experience the biggest growth declines. As a group, they were projected to grow by minus 4.9%. More diversified economies were projected to do much better than that. A category including Kenya. As groups, the EAC and 𝗬𝗎𝗻 countries were the ones doing best in Sub-Saharan Africa, projected to grow on average by around 1 to 1.5% in 2020. So low as these numbers may seem overall, they're really not bad compared to the rest of the world. That's important to stress. Global growth was projected at minus 4.9%, with minus 8% in advanced economies and minus 3% in emerging markets and developing countries as a whole. Okay, so that was the outlook in June. Now let's look at what has been happening in the past few months since those projections were put together. First, I would note that we're starting to get a full picture of what actually happened to economies in the second quarter of the year. Not surprisingly, in many countries, it was the worst quarterly growth performance on record. We've seen year-on-year declines of 10 to 15% in real GDP in many advanced economies. Minus 17% in South Africa, minus 6% in Nigeria. The second point is that we're seeing economies around the world starting to pick up along with easing of COVID containment measures. The recovery is uneven. Some countries have seen COVID flare up and have had to tighten containment measures again. But overall, I think it's clear that the second quarter was the bottom for most countries, and activity is picking up speed. In Kenya, the bottom for economic activity was quite clearly in April-May. We've since then seen an upturn in most activity indicators, as we've also been hearing just now from the Deputy Governor. Exports have been driven by a good year for agriculture. They're up solidly year on year in the latest data. It's not a full recovery. Electricity production is down slightly from a year ago. So are imports, oil imports in particular, but also non-oil imports. Hospitality, of course, is still deeply depressed. But overall, there has been an important improvement in economic activity since the trough in April-May. You see that on the streets here in Nairobi, where things are largely back to normal, traffic included. So These encouraging signs for economic activity, as we also have heard, have been reinforced by a significant improvement in COVID numbers over the past month or so. But there are also important remaining challenges. COVID, of course, is still there. We don't have a cure yet, and with that, all the health challenges and risks. Many have lost their jobs. We've seen significant declines in employment numbers in the second quarter. Schools are still closed. This will have long-term costs. We've, on the fiscal side, seen government revenue suffer, and with that, fiscal pressures that will have to be dealt with. In the financial sector and private sector generally, a large proportion of loans were restructured following COVID, given the hits to household and corporate balance sheets. What happens when these loans mature? Will lenders be in a capacity to pay? So those are some of the key questions and pressure points. Overall, I think it's important to bear in mind that COVID has really been a shock of historic proportions. It would be wrong to assume that it'll be overcome quickly. But I think also looking at the numbers coming out of Kenya, it's fair to say that the outturns here have so far been better than what we at the IMF expected in the June Rio update. At that time, we projected growth of minus 0.3% for this year, as has been noted. So I think in the World Economic Outlook that comes out next month, we can expect somewhat of an upward revision to that number. Let me end there. Thank you all.
Thank you, Tobias. That's very encouraging to hear that most recent data coming out of Kenya is encouraging, and that we may see an upward revision to that negative 0.3% growth number for Kenya. We'll now head into the Q&A session. I invite those watching and listening in to submit their questions in the comment box, which is on the right-hand side of your video webcast. In the meanwhile, I'll kick off this discussion with a couple of questions. I'll start off with Tobias. I'll start off with yourself. Contrary to other sub-Saharan African markets, Kenya's inflation has remained relatively low. I mean, if you look at Ghana's inflation, it's moved into the double digits after being relatively stable in the 7 to 8% region last year. Nigeria has continued to accelerate in double digits. Zambia has gone up, but Kenya's has remained relatively low in the mid-single digits. What do you attribute that to? Is it largely the low oil prices, or is subdued demand also an issue, as that would speak to the consumer in Kenya?
Yes, I mean, I think that the low headline inflation, 4.4%, the latest reading for August, has been coming down mainly because food inflation has been coming down. If you look at core inflation, stripping out food and fuel, it's been low and stable, steady at around 2% for over a year. It's really in food that we've seen the big movement. Food inflation was rising up to the early months of this year, at some point reaching around 15% year on year. But it's been declining quite sharply since that, to around 5% in the latest reading, I believe, reflecting the good harvest, the good year for agriculture that we've also been seeing in the export numbers, as has been mentioned. So overall, I would say underlying inflation in Kenya has been modest, well anchored. The movement we've been seeing is really a story about food prices.
Okay. Thank you. My next question is to the Deputy Governor, and this is a question that's come through from some of the investors. They want to know when the central bank plans on giving its final approvals for the bank's risk pricing templates, and what sort of pricing changes will the central bank not be happy with. Sorry, Deputy Governor, you're on mute.
Thank you for that question, and thank you for telling me I was on mute. Kenya's objective is to be a financial center of repute and a financial place for international and local and Pan-African investors. And to do that, what we're trying to do is to get to a place where we can reflect the world's best practice. And I think Charles has mentioned already that pricing across the African continent has been problematic. And when you look at some of the historic pricing approaches, is that there's an assumption that all customers are the same, and therefore the pricing that's assigned is assigned to a block of customers. And what that means is that there's big inefficiencies in that pricing structure, because some of the best credit is subsidizing some credit that is not of the same standard. And now we have all this automation and technology and modern solutions. It's really time that that differentiation between customers becomes apparent, and that customers that have had and built a good credit history can come to a bank and get a different pricing, although they belong to the same economic block as someone else, because of the risk that they pose as opposed to others. So what we're looking for is all banks to start adopting this new approach. And we're very pleased that the digital banking phenomena has actually brought that out even more. And so the banks are moving in that direction. And really, it's for us to nudge them so that they can understand and settle into a structure that works even better for them. Because the old historic approach also had with it a lot of problems in risk pricing. And so I hope that answers the question. It's more a question of us working with our banks. It's not a deadline that you don't finish by this date and then this happens. It's a question of working together. But it comes down to technology and using the new AI and other approaches in order to understand and differentiate between your customers.
Okay. Thank you, Deputy Governor. My next question is to Charlie. Last month at Jackson Hole, we saw the Fed chair announce a new approach to inflation that could keep interest rates lower for longer, which implies a weaker dollar. What does a weak US dollar and low EM inflation mean for currencies in emerging and frontier markets, and for East Africa in particular?
Well, big picture, we've got emerging market foreign exchange is still about the cheapest it's been in 15 years. And the most startling undervalued currencies are Latin America, South Africa, countries which happen also to have been hit pretty hard, particularly hard in Latin America, by COVID, and then hit by the commodity story as well. So my assumption is that they are going to be the ones that benefit considerably as we go into 2021 and beyond. But one of the trends that I find most interesting is that the disinflation story that we saw in Japan from the 1990s, Europe in the 2000s, and I'd argue probably in the States in the 2010s, it's just the death of inflation, really, since the peak back in 1980. The death of developed market inflation, I think, might also be coming into emerging markets. And so the consequence of that is we're now seeing interest rates in places like Russia and Brazil at 200-year lows. And we've never, like since independence in Brazil in 1823, I think it was, and Russia as well, the lowest interest rates they've ever had. low single digits. And I think South Africa even, despite its massive deficits, also extremely low interest rates, and they may stay there because we may not see inflation come back. So I think this is going to change the carry trade story a bit. You'll have to be borrowing at the short end in these local currencies and buying the long end, and perhaps the local yield curves in emerging markets will flatten at quite low levels. And at that point, sometime in the next few years, investors will be saying, where is the yield on offer? We've already talked about the dollar bond markets, I think will be very attractive. But I think it's going to also shift into local currency as well. But I'm not sure that inflation is going to die in the same way in frontier markets. And I think that's true for a number of reasons. Firstly, inflation in frontier markets tends to be much more food price dependent. 30 to 50% of CPI baskets tend to be food versus 20 in emerging or 10 in developed. And food is obviously volatile and depends on the harvests. Good numbers we get in Kenya now is helped obviously by the harvest, as the Deputy Governor said. Secondly, there's oil, which can't be controlled. And thirdly, there's the currency itself. But there I would think the weaker dollar is going to be helpful. The weaker dollar will help the local currency GDP versus external debt ratios look better. The debt to GDP ratios will look better. And you get into a virtuous circle where people are prepared to lend more because the dollar's weakening. So frontier markets look like they can manage more debt. And then they can grow faster because they can borrow more. And that again encourages more money in. We saw that to some extent in the late 2000s. And I think we're going to see an echo of that in the 2020s. But I guess what I find particularly interesting about Kenya is that although the currency looks a bit strong on our real effective exchange rate models, the currency has held up well for many years. And when inflation drops as much as this and is sitting down at 4 or 5%, any worsening of that real effective exchange rate analysis isn't really happening. It's very different in Nigeria, where inflation keeps on being double digit. So every year, the currency is looking more and more overvalued. So I'm quite encouraged by what we're seeing in Kenya at the moment. I think it's good news. I'd be quite interested, if it's okay to jump in with one question about on the currency, because our real effective exchange rate numbers, we have two models, which complicates things in one in London and one that Yvonne does. But the currency is moving towards that in the last few months in Kenya. It's gone from 100 to 101 to about 108. And I was wondering what the central bank sees as having contributed to that.
I don't know, Yvonne, do you want me to respond?
Yes, the question's for you, Deputy Governor.
Okay. I think what we saw is, I don't know, the 101 number seems to be a little old. I think because we came into the year, we were around 103. With the advent of COVID, we saw that go to 105. We compared that movement with what was happening across the African continent, and we saw that 3 to 4% was fairly standard, and so, as I say, we don't have a rate on the shilling, but we observe. So that was fairly standard. In the recent past, we've seen something quite interesting, because normally around September time, you have a lot of dividends being paid. And obviously with the banking sector this year, it's not as predictable as it was in the past. In the past, you knew that year upon year, dividends would remain fairly steady. But obviously this year, some banks have decided not to pay dividends, etc., etc. But we did see some large dividend flows coming through, which put some pressure on the shilling. So I would say that that's my understanding of it at this point in time. But the flows in and out still remain fairly balanced. The reserves are robust. The current account is going in, it's not widening. So we see no reason for the shilling to take a lot of pressure.
Thank you, Deputy Governor. My next question is to the IMF, and this is regarding the fiscal situation. So that's one area of concern for Kenya. So prior to the pandemic, the government did struggle to meet its revenue to GDP targets, and that resulted in breaches of the deficit. And this particular year, taxes were cut, rightly so, to help stimulate growth. However, my question to you is, what does that imply for the revenue outlook over the medium term, and also the ability for their government to achieve the fiscal consolidation targets?
Yeah. So on revenue, I think first it's important to note that the tax cuts that were undertaken in April helped stimulate economic activity and were an important part of Kenya's COVID response. Providing stimulus is of course sound policy when economies slump. So that was a positive there. The question then is more forward-looking and looking ahead to a time when recovery from COVID permits a reversal of stimulus. Then it's going to be important to bring the revenue to GDP ratio back up. This is essential in terms of being able to reduce the fiscal deficit, bring debt to GDP ratios down, while creating room for needed spending. On revenues, I would also note that there are different ways to bring them up. What perhaps has not been getting as much attention as the tax cuts is that there has been, in fact, significant action to remove tax expenditures and streamline the tax system alongside the tax cuts. Kenya has had large tax expenditures, estimated at 5 to 6% of GDP, has now taken steps to bring that down by around 1 percentage point of GDP. So that's part of, I think, the story towards bringing revenues back up again to help with the fiscal pressures. The removing of the exemptions facilitates administration. It makes the tax system more efficient. So I think that's a very positive part of the process.
Okay. Thank you. That leads on to my next question, Charlie, and this one's for you. As you know, debt metrics have deteriorated quite a bit in Sub-Saharan Africa, in some countries more than others. How do you expect this crisis to impact the region and Kenya's access to commercial loans going forward over the medium term in particular? And do you think Frontier Africa and Kenya in particular remain compelling for bond investors?
I think the yields are very interesting, but we are going to see countries, and we've just seen Angola get downgraded by Moody's last night. I think they were downgraded by another agency on Friday night. We've got debt restructuring talks in Zambia. I don't think it's a coincidence that they are the highest fertility countries, or among the highest fertility countries in Africa, which comes back to the whole lack of savings and the dependence on foreign borrowing story that we've talked about. So there's undoubtedly going to be countries that are going to struggle. And I think for the next few months, I still think global investors are going to be fairly cautious ahead of the US elections. No one's going to be taking big bets, I don't think, in terms of asset allocation. I think the shift comes in next year. But what's striking is already how low the yields are in emerging markets. And obviously, we focus quite a lot on Russia as well. And we're seeing corporates being able to issue in relatively low single digits out of Russia, even with all the noise about you know, the Navalny story and the Germans and the tension going on there, still cost in EM and the yield on offer to investors is very low. So I think that there has to be a shift back towards looking for where the yield is available, and I think the more countries that avoid this pressure to bail in the private sector that's come from the World Bank, or almost 𝗪𝗲𝗰, I think in particular, the better, because I think there's so much capital that could be put to work in the continent, but would be deterred if, when a crisis comes, you get penalized. And I guess this is one of my original points about it, is that when the crisis hit in February, March, developed markets, the Fed comes in and bails everyone out in the private sector. If you're a private sector investor in US stock market, you get bailed out by the Fed. But somehow, if you're a private sector investor in African debt, then the pressure seemed to be you should be penalized, which runs entirely counter to what we've been trying to promote for the last decade or more, which is that Africa is normalizing. This is we're seeing development and success and growth, as Tobias already mentioned. Some of the best growth, both in the global financial crisis, came from Africa, and again this time is going to come from Africa. And money should be coming to the continent, not penalized for coming to the continent. And that's why I think it's quite important that countries try and avoid this pressure to bail in the private sector, because I think the private sector will offer far more money to the continent in the coming decade. There will be exceptions. To come back to the original, my start, there will be exceptions. And Angola or Zambia, they're gonna struggle for a little while, and there will inevitably be others in a continent this size. But I think the money is likely to flow, and that's partly again premised on a shift in the American politics as well, that a less protectionist, less trade war-minded president will shift global sentiment towards emerging markets in general, as well as Africa. I think that's coming.
Thanks, Charlie. My next question is for the Deputy Governor. This was from our banks analyst, who was looking at NPLs in the banking sector, which stood at around 13% in June. He thinks they're already elevated going into the crisis and naturally deteriorated further this year. And he wanted to find out whether the central bank is comfortable with NPA ratios in the 15 to 20% range in 2021, or could it potentially compel the banks to write off fully provisioned assets?
Thank you. I think that this is one of the issues that I brought up earlier and said that I hoped I'd have the opportunity to return to. I think when we look at the NPLs in the Kenyan market, you'll excuse me. Yes, I found my notes on this. Firstly, we're saying that the COVID has been a global crisis, and so all banks around the world will be looking at their asset quality. So it's not unique to the African continent or to Kenya. So I think that's the first thing that we need to put on the table. The second thing is that our banks were well capitalized and very liquid, strong liquidity positions as we entered this crisis. So the banks had managed 50% liquidity. So they were very well positioned for the crisis. Our banks still remain profitable at 17%, as I said earlier. The issue was the asset quality, and particularly credit, as we go forward. So we acted very quickly, and we said that we want our banks to look at their credit position, their asset quality position, as at the 2nd of March, 2020. And as I told you before, the COVID crisis hit us on the 13th. And we said anything before that should be treated as per normal structures. Anything post that, when we start looking at the deterioration of credit post the 2nd of March, should be classified as partly as a COVID-related issue. And as a result, what we said is that the bank should look to, what's the right way, to be flexible and accommodative to customers who are hit in that way. And then we also took our own actions by reducing the CRR and providing our banking sector with additional funding to help in this respect. Our view is that it's very important that not only our banks get across the post-COVID line, but also their customers. If you get a bank that has no customers and it's strong post-COVID, it's still not a strong bank, it's still a viable bank. So the two need to cross together. But at the same time, we don't want to cross with institutions or with companies that are failing out of their own actions. There's a difference between your own actions and COVID. And so we wanted to distinguish between the two. NPLs in July, as I say, are 13.3, but in August we're 13.1, so we're seeing a stabilization of that position. When I look at the actual numbers that we have, we gave additional liquidity in the banking sector to the CRR reduction of $352 million, which is $14 million, which is about 89% has been utilized. It's been utilized where we wanted it to be utilized. Tourism, trade, transport, communication, and real estate. And the restructuring of our banking sector is about 29% of the total book. Now, the issue is what happens as you go forward, which is also very, very important. And what we're saying is that we continue to diligently monitor and watch the NPLs. And as I say, they've stabilized. And in addition to that, we continue to engage with the global debate on how these will be managed globally, because it's not just a Kenyan problem. And we want to align ourselves with the best in class. So yes, is there a structure around it? Yes. Thank you.
Thank you very much for that. I think Charlie has a question for you around QE.
Yes, Deputy Governor. What struck me in this crisis was that in 2008, developed markets did QE, emerging markets cut interest rates, and frontier did not. In this crisis, developed markets did bigger QE. Emerging markets like South Africa, interestingly, did a bit of QE, and frontier was able to cut interest rates. So it feels like all central banks everywhere are generally getting more dovish or reacting in more different ways. Did Kenya ever consider QE? Did this kind of policy stance, just in terms of the concerns about crowding out, the government's borrowing a lot, credit actually seems to be okay. There seems to be real credit growth in Kenya, which is quite interesting and quite encouraging. But did the central bank ever think about QE type policies?
I think what happened was that when the crisis struck us, we engaged with a Pan-African debate, and then you looked as to what was the best response for your domestic economy at that time. And so the issues and the solutions and the measures that were put in place aligned to what we believed would be the best for the Kenyan, which would respond best to the Kenyan economy. But you are, of course, aware that the government also had quite a lot of stimulus. They had programs for vulnerable groups. They're even in the budget that has passed recently in Parliament for this year. There's a large amount of additional stimulus in that program. And then in addition, there's a new program that's happening, which is a credit guarantee scheme for MSMEs. So we looked at what we had, we looked at what was available, and then we decided which would be best in the circumstances for Kenya.
Okay, thank you very much. We have to wind down now, and I have to pose one question that's come through from the audience. This is for you, Tobias. It's regarding the currency. It's often a question that comes up. Basically, the question is around the misalignment of the shilling. And I think they're referring to a 2008 IMF report, which at the time talked about the currency being overvalued and around 17% overvalued. I think they want an update on what the IMF's view is on the valuation of the currency today and how your mode of valuation differs from that of the central bank.
Thank you, Yvonne. So report that you referred to was from 2018 and was in fact looking in particular at 2017 data, if I recall. So it's somewhat dated, I would say. We haven't put out an updated assessment of the exchange rate at this point. So what I would just note is that we've actually seen a improvement in the external current account since 2017, and in particular, actually this year. So I think that alongside with that modest depreciation of the shilling we've seen would suggest that what misalignment there may have been previously would be somewhat less at this point. But as I said, we still need to do that in-depth analysis. Thank you.
Okay, thank you very much. My final question will be to the Deputy Governor as a senior official in Kenya. As you know, the audience is largely made up of investors who are investing across several frontier and emerging markets, including Kenya. Please tell them why they should invest in Kenya at this point in time.
Thank you, Renaissance, for giving us this opportunity, and thank you to the audience for being interested in listening to Kenya. I would say that Kenya is the third largest, arguably the third largest Sub-Saharan African economy. We don't have mineral resources. Our strength comes from our commitment, hard work, adherence to the law, and international collaboration. Kenya is one of Africa's most diverse economies, which protects us somewhat from shocks, global and otherwise, when they come. We're not reliant on commodity exports, over 40% of our exports to the region, and we have an open and free capital and forex markets. Kenya, we believe in ourselves. 95% of our domestic debt, we have bought ourselves. Above 75% of our securities exchange is owned by Kenyans. And you know, when people own something themselves and believe in themselves, then that's a good reason for other people to believe in them. Kenya has sustained macroeconomic stability despite global and national shocks. Inflation around 5%, exchange rate relatively stable, growth around 5% plus for the last 10 years, adequate reserves, predictable current account, stable, resilient banking system, which is anchored on international best practice. We're a global digital leader. Kenyans are innovative with a strong private sector. Kenya is one of the leading and fastest growing domestic debt markets in Africa. Its predictable yield curve, safe settlement and custody system, managed by the central bank, no forex restrictions on movements. And I'd like to announce as I close that yesterday we launched a project to introduce a new central settlement depository system within Kenya. And this system is aligned to the one that won the Global Settlement System Central Bank Award in 2020. So in a year and a half's time, we'll also have the best settlement structure that the world recognizes as the best settlement structure. Thank you very much indeed.
Thank you. And I'd like to take this opportunity to thank the panelists for giving up their valuable time and for this engaging discussion we've just had. I'd like to thank the audience that dialed in and participated with their questions that contributed to this discussion. My takeaway from our panel session is that recent data coming out of Kenya is encouraging and does suggest that Kenya may have escaped the worst of this crisis. Thank you all. I hope you enjoy the rest of the conference.